Hello, this is a synopsis of Chapter 8. And in Chapter 8, we're going to be looking at risk and rates of return. So with risk, we assume that investors are rational, and we assume that being rational investors, we would prefer less risk to more risk. So investors are risk averse. And if we're going to invest in an investment, we want to be compensated for that risk. So the riskier an investment or the riskier a stock, the higher return we should demand to be compensated for the risk. So we're going to look at some different ways to measure risk and look at this risk and return concept. So first of all, there's two types of investment risk. There's standalone risk and there's portfolio risk. Standalone risk is the risk of investing in just one investment. So if you bought one stock, that's the standalone risk, the risk of that individual stock. Portfolio risk is the risk that you have in a whole basket of stocks in a portfolio. You may remember these curves from QBA 282 and 283. This is just your normal distribution. And this is showing that the expected, the average rate of return on this stock for firm X and for firm Y, both have an average rate of return, which they call an expected rate of return of 15%. So what this is saying is that over the years, on average, you would expect to receive a 15% return from either of these stocks. However, we notice that firm Y has a much wider distribution. So you could make over 100% in firm Y or lose 70% on any given year. Firm X has a tighter distribution. So this is illustrating that firm Y is riskier than firm X. Risk meaning the probability of negative returns. And so the wider the distribution, the greater the risk. And as you may recall, the variation around the mean, we measure that by using standard deviation. Now, if we invested in a treasury, in a T-bill, which is a treasury, a CD or a T-bill that just gives us a fixed percent. For example, if you went to the bank and you bought a certificate of deposit, a CD that was paying 1%, you would see just a straight line of 1% because that's not going to deviate. It's going to pay you 1%. And the rate that you can get on these, the T-bill is generally called the risk-free rate. So because that's the rate that you would get if you bought an investment that was totally risk-free, like a CD or a T-bill. All right, so let's look at some of these realized rates of return. Generally, we consider T-bills to be risk-free, even though they do have a small standard deviation. But this just shows you, let me start trying to make this bigger here for y'all. Okay, so this just shows you over time what the average return has been for different types of investments and what the standard deviation has been. So you can look at the risk, the risk and return for each of these. Now this is we're going to use these examples to look at expected returns and standard deviation. These are some hypothetical investment alternatives. You could invest in treasury bills. These are different stocks. This is HT is high-tech stock. This is a collection agency. This is US Rubber. And this is just a portfolio of all stocks in the market. So what this is showing is that these are probability distributions. So for example, they think there's a 40% chance that the economy is going to be average this year. If that's the case, these are what all of these returns would be. If we have a boom, we would make 42% in high tech, 10% chance of that happening, but we would lose 20% in the collection agency stock. If we had a recession, we would lose 29% in high tech, but make 24% in the collection agency. So you can see these are just the returns over each of these states of the economy. So next we're going to we're going to compute a weighted average or the expected return, which is a weighted average of these stocks. So in other words, to compute the expected return of high tech, we're going to compute the weighted average, which is going to be 0.1 times negative 29.5 plus 0.2 times negative 9.5 and so forth to get the average return or the expected return. So T-bills are going to have a 3% promised return regardless of the economy, but we need to calculate the expected return of these others. So here's the formula for the expected return, simply a weighted average. It's the sum of each probability times the return. So here they're calculating the expected return of high tech. So as I said, it's just each probability times the return for that probability, and you sum all those up. So the expected return for high tech is 9.9%. So if you invested in that stock over the years, you can, on average, you can expect to get an annual return of 9.9%. Then they go ahead and calculate the expected return for the rest of these. The market portfolio is 8%, US rubber is 7.3, collections is 1.2. So you might ask yourself, well, why not just put everything in high tech? That's the largest expected return. Well, the reason is because you want to be diversified. Let's go back and see what's going on here with this, this chart. So even though collections on average only makes a 1.2% return, as we saw on that last slide, let's say that I had a 50-50 portfolio in these two. Well, you see, these are really giving me these two investments would give me some really good diversification benefits because when one is up, the other is down. So that's the whole goal as an investor, is to buy stocks that help you to diversify. So you want to buy stocks that have a negative correlation if possible, or as low of a correlation as you can find if as possible. So for example, during the last recession that we had, 2007, 2009, stocks on average went down around anywhere between 35 and 50%, but Dollar General was actually positive. So that would be an example of a stock that has a negative correlation with many other stocks or the market. Okay, so let's go back to here. So we calculated the expected return. Okay, now we're going to look at the risk. We're going to calculate the standard deviation, which shows us the variation of these returns. So this is the formula for the standard deviation. It's the square root of the variance. So it's going to be the square root of the sum of each return in each state of the economy minus the expected return squared times the probability. So here they're working out the problem here. So they've used T-bills as the long example here. So T-bills had an average return of 3%, and T-bills didn't deviate. The return was 3% all the way down the line. So they're just taking the return in each state of the economy minus the average return squared times the probability. You sum all this up, and then you take the square root. So you can hit your square root button on your calculator, or you can go x to the y into the 0.5 power to the half power. That'll give you that'll give you the standard deviation also. So go ahead and, as for practice, try to calculate the standard deviation for high tech. So that's going to be, go back and look at that slide and you're going to put in the first return for high tech minus the average return or the expected return squared times 0.1 plus then the next return for high tech minus the average squared and so forth. So try to work these, at least one of these problems, so you know how to calculate the standard deviation. So that shows the risk. So we see that based on this, here they're just graphing. Here's a T-bill, here's US rubber, here's high tech. So based on this, high tech is the riskiest stock, then US rubber, as far as just strictly looking at the standard deviation, then the market, then the collection agency. All right, so the larger the standard deviation, the riskier the investment is. All right, so here we're seeing, typically you're going to see the lower return, the higher return is going to give you a higher risk, typically. Except the market, and well, if you typically the higher return, the higher risk. Not always the case, because you can see here the market is giving you an 8% return, but standard deviation only 15.2, whereas US rubber, lower return, but a bit higher risk. Now, there's another there's another way to there's a way to standardize the risk, and that's called the coefficient of variation. So typically, if you had two investments and each one was a higher return and a higher risk, it would be or let me back up a second. Let's say you had two investments and they both had the same expected return, but one had a higher risk. Well, you would invest in the one with the lower risk, obviously, if they have the same expected return. If you have two situations where they have the same risk, the same standard deviation, but one has a higher expected return, then you would invest in that one. But a lot of times it's not that cut and dry. You might have a situation like this. Let's just say, for example, high tech is earning us 9.9%, has a 20% return, 20% standard deviation. This gives us, US rubber gives us a lower return, but it's lower risk. So which one is going to give you the best return for the risk? Well, we can't really calculate that unless we will know that for sure if we calculate the coefficient of variation. So basically, this tells us what the risk is per unit of return. It shows the just like it says here, it shows the risk per unit of return. So the easiest way to think of this is, let's say you're in the grocery store and you're trying to find, you see there's a 6-ounce can of coffee, a 12-ounce can of coffee, and a 16-ounce can of coffee. And you're trying to see which one is the best buy. So if you divided the price by the number of ounces, that's going to give you the lowest price per ounce. That's kind of what we're doing here, is to standardize it. So the CV is simply the standard deviation divided by the expected return. Okay, so let's look at here. So here's our different CVs. So collections is giving us the highest risk per unit of return. So with the CV, the lower the number, the better. Okay, so if you forget about the market, but if you look at US rubber, that's actually giving us the lowest risk per unit of return. I'm sorry, high tech. High tech is giving us the lowest risk per unit of return. So even though high tech had a very high standard deviation, the return was very high. So this would actually be our best investment from a risk return perspective, high tech, followed by US rubber and then collections. But, this is only part of the story, because you want a portfolio that's very diversified, and you can achieve diversification benefits by adding collections to your portfolio, as we're going to see in a minute. Right. Okay, we're going to skip the Sharpe ratio. This is just another way of measuring risk. They added this to this new edition of the book, but I really don't cover it in this class. It's so if you have the opportunity to take the Finance 356, which is the first investment selective, we do go over the Sharpe ratio in that class. So let's skip that. All right. Okay, so let's look at a portfolio now. We're going to assume that we have $50,000 in both high tech and collections. We're going to construct a two stock portfolio, and we're going to add high tech and collections. And if you go back and look at their risk and return, the returns they're very negatively correlated. When one's up, the other's down. So let's look and see what happens when we have this 50-50 portfolio. So first of all, let's calculate the expected return of the portfolio. Well, the easiest way to do that is just to take the two returns and do a weighted average. So we have half of our money in high tech, which had a expected return of 9.9%. Half of our money in collections has a return of 1.2. So our average return is 5.5%. Since we have the same amount in each one, 50%, 50%, an easier way to do this is just take 9.9 plus 1.2 divided by 2. You get the same number. Okay, so the average return is 5.5%. Now we're going to calculate the standard deviation. Now, in order to calculate the standard deviation, because of the correlation, these different, because of the negative correlation, you can't just take the average of the two standard deviations. You have to do an extra step. What we have to do is we have to find out the average of each of the portfolio average in each of these states of the economy. And then we have to use these numbers to calculate the standard deviation. All right, so we're just finding the average return in each of these states of the economy. So if we had this 50-50 portfolio, and if we had a recession, we would make negative 2.5%. We've just taken the average of these two numbers, 24.5 plus a negative 29.5 divided by 2. Find the average of these two, it's 0.5 and so forth. Now here they're just showing you another way to get the expected return. If you calculate a weighted average of these returns for the portfolio, you would get the 5.5% expected return. But it's just easier to do it this way. Okay, so in order to calculate the standard deviation, we have to find the average for each state of the economy. And on the next slide, they're showing us how they calculate the standard deviation. So they're going to take this return here, negative 2.5% minus the average squared times the probability, add all these together, take the square root, and we get a standard deviation of 4.6%. So for this 50-50 portfolio, we find that the expected return is 5.5%, but the standard deviation has gone all the way down to 4.6%. So we've really reduced our risk. There's the coefficient of variation. So let's take a look at these conclusions then. So the standard deviation for high tech was 20%. Okay. The standard deviation for collections was 11.2%. We've reduced it by basically 75%. By putting these two stocks in a portfolio, we've reduced our standard deviation all the way down to 4.6%. So here's the takeaway from this. If you have a portfolio of stocks that have a very low correlation or a negative correlation, you can really reduce your risk without sacrificing too much on your return. So it's important to have a diversified portfolio. And you want to have stocks that are negatively correlated. So for example, you wouldn't buy ExxonMobil and Chevron because they're in the same industry. You would buy stocks in all different industries and try to find these low correlations. Okay, so here's just some general comments about risk. The average standard deviation, the standard deviation for an average stock is 35%. So you can see that it's very risky overall. There can be a lot of swings in the market. So again, it's important to have a diversified portfolio. Anyway, so that's all I wanted to say about that. Okay, now we're going to look at correlation. This is what I'm going to talk about next. So the correlation ranges from -1 to 1. If two stocks that are perfectly positively correlated would have a correlation coefficient of +1. Like think ExxonMobil and Chevron. If they moved in tandem and totally identical, they would be perfectly positively correlated. If you bought two stocks that were perfectly negatively correlated, when one is up, the other's down, and so forth. The market in general has a correlation of about positive 0.63. So if one were up $1, the other one would be up 63 cents and vice versa. So you see that most stocks are pretty positively correlated. So it's hard to find stocks that are negatively correlated or have a low correlation, but it can be done. Like, as I mentioned earlier with Dollar General, for example, um, that stock had a negative correlation with the rest of the market during the last recession. Also, if you think about buying, you can invest in funds that invest in gold and silver. Those tend to have a negative correlation, but not always. Also, there's something called REITs, real estate investment trusts. Those are mutual funds or exchange traded funds where their investments in commercial real estate, shopping malls, apartment complexes, businesses. And so real estate tends to have a negative correlation with the overall market as well. So that's a good place to diversify also. Okay, so that was the perfectly negative correlation example. Here's two stocks that are perfectly positively correlated. So you have no diversification benefit from investing in those two. This is typically what happens. You've got a partial correlation. Here's a plus 0.35. And so this is what you end up with. So what they're saying here is in this chart here. And here they're showing you that you have two types of risk. You have portfolio risk and you have market risk. Okay, so portfolio risk is called, this is called portfolio risk or diversifiable risk. It's also called unsystematic risk. This is risk that can be diversified away by buying a basket of stocks. Market risk or systematic risk or non-diversifiable risk, you can't get rid of. So what they're saying here is that if you own about 40 stocks, well, it starts at about 20, 25. If you own between 25 to 40 stocks, or let's just say 40, you've gotten rid of all this diversifiable risk. So buying a portfolio of stocks, or if you invest in one mutual fund, they have probably over 50 stocks in that mutual fund. So investing in a mutual fund, if you're a small investor, or if you have some more money, buying a basket of, say, 40 stocks, you've diversified away all of the diversifiable risk. This market risk is non-diversifiable. That's the risk of us going into a recession, something that affects everything, pandemic, terrorist attack, bad news or economic news. So we can't get rid of through diversification. All right, next we're going to talk about this capital asset pricing model. Now, this is just a way to look at risk and say what our required return should be based on the amount of risk that we're taking. So this is a really simple formula. And instead of using the standard deviation to measure risk, we're using something called beta to measure risk. So let me explain what beta is, and then I'll come back to that formula. So beta just shows that there's a beta for each stock. If you go to Yahoo Finance and you look up a stock, it'll tell you what the beta is. So the market has a beta of 1. So they do this regression analysis where they take weekly market returns, typically it's weekly, and then they'll take a stock. So let's say they take ExxonMobil, for example, usually has a beta of less than 1. They're not as risky as the market. So let's say that they regress the weekly returns for ExxonMobil and the market in general. And they found that ExxonMobil was not as risky as the market. When the market's up, ExxonMobil is not up by as much. When the market's down, it's not down by as much. So it's going to have a beta that's less than the market, less than 1. So if a stock has a beta of 1, it moves identical with the market. If a stock has a beta of less than 1, it's not as risky as the market. Greater than 1, it's going to be riskier than the market. So the beta just shows how risky a stock is in relation to the market. So back to this formula now. So in order to find the required return, the return that we demand if we're going to be compensated for the risk of investing in the stock, we would want to make the risk-free rate, that's the rate you could get on a T-bill, plus the risk premium. The risk premium is the return in the market minus the risk-free rate. So if we take the risk premium, the return in the market, minus the risk-free rate, that's the risk premium that people are getting for investing in the stock market. You multiply that by the stock's beta, add that to the risk-free rate, and you get the required return. So once you find the required return, then you can go back and look at the expected return. What do analysts think this stock is going to, the return for the stock is going to be this year? That's what we did at the beginning of the chapter, expected return. And you compare the two. So if the expected return is more than the required return, the stock is a buy, it's undervalued. But if it's just the opposite, if the required return is up here, but they're only expecting a return down here, the stock would not be a buy, it's overvalued. So it just shows us if it's another way to see what the required, it's a way to see what the required return should be on a stock to compensate you for your risk. And then you can look and see what the expected return is and compare that to see if the stock is a good buy or not. Okay, so we went over beta. This just explains what I just told you about beta. All right. So they'll calculate betas, and they'll calculate if you take hang on a second, let me go to a different. Okay, sorry about that. Let me go back here. Okay, so what they'll do is they'll take you can calculate the required rate of return for a lot of different stocks, and you can get this line. This is called the security market line, because the higher risk, the higher the return is going to be. So let me show you this. So here we have, for example, here's high tech. High tech has a beta of 1.31. And so when you calculate the required return for beta, or the required return for high tech, it's going to give you a line like this. Collections has a line like this. But typically, you see this is the risk and this is the return. And you typically end up with these stocks kind of just basically being around, clustering around this security market line, which they should show us later in the slides. We'll get to that. All right. So anyway, remember, this is the expected return for high tech. And that you don't have to calculate the beta. You'll be given the beta, because they have to calculate that using a regression analysis. So here's the beta for all these companies. So look, Collections has a negative beta. It's rare to see that. If you see a negative beta or a really low beta, that tells you that that's a great stock to add to your portfolio for diversification, assuming that the returns are there, but the required return is better than the expected return. So here's the different betas. So we see high tech is the most risky. So now we're going to calculate the required return for each of these. This was the expected return. So let's calculate the required return using the capital asset pricing model and see if these stocks are a good buy or not. So here this is the formula. So you just put in the beta, and they give you the risk-free rate and they give you the return on the market. So the risk-free rate is 3%. They think the return on the market is going to be 8%. So if you take the difference here, they're just explaining that's the risk premium, which means if I'm going to invest in the market versus investing in a T-bill, I'm going to be compensated 5% for my risk. That's if a beta is 1, but for a riskier stock, I want to be compensated more. But the difference between these two is the risk premium. Now, sometimes they'll tell you the market return, but sometimes they don't tell you the market return. Sometimes they just tell you the risk premium, which means they've already subtracted it out here. Okay, so let's take a look here. So this is the required return for each of these stocks using the capital asset pricing model. Here's high tech and so forth. So now let's compare the required return to the expected return. So high tech had a required return of 9.55%, but they think it's going to return 9.9. So this is a buy. It's undervalued. US rubber is overvalued. Here's the required return. They only think it's going to return 7.3%. So that's not a buy right now. And then collections is also undervalued by quite a bit there. All right, so that's how you use beta to put into the capital asset pricing model and calculate the required return. Then you can compare that to the expected return. Just one way to see if a stock is a good buy or not. Okay, here's the security market line that I was trying to explain earlier. So here we have beta, the riskiness of a stock. Here we have the return. All right. And the security market line, what they've done here is the risk-free rate is 3%. So it's going to cross over here. And then the market return, if you use the capital asset pricing model and put in a beta of 1, that gives you the market return, which is 8%. That's also given. So using the risk-free rate and the market return, they calculate this security market line. So as I was mentioning before, you can calculate the required return for various stocks, and they tend to cluster around this security market line. Okay, so here you're getting a higher return. So if you're right on the line, you're getting it, it's right on. It's a fair, you're getting the proper amount of return for the risk. Up here, you are getting really a higher return for the risk. Up here, it's a lower return for the risk. So they tend to just, like I said, cluster around this line. Now you can calculate the beta of a portfolio. So this is just showing you we're back to this 50-50 collection high-tech portfolio. What would be the beta of that portfolio? Well, take a weighted average of the two betas, and we get a beta of 0.4. All right, this is just saying what if inflation raised the risk-free rate, then the security market line is going to move up at all levels by 3%. If inflation were 3% and interest rates went up 3%. What if risk aversion increased? Well, this probably happened. I mean, there's been some studies that has shown that after the recession, 2007, 2009, risk aversion did increase. People wanted to have a greater return to be induced to be in the market because of the shock of the recession and the significant declines in the market. So if risk aversion increases, then you're going to see the slope is going to increase. The slope of the security market line will increase because people are more risk averse. They're demanding a higher return for equal amounts of risk. All right, so what's the problem with the capital asset pricing model? Well, I would just say, let's go back and look at the formula here. And it's all based on historical information, and you can't predict the future with it. So that's the problem. So the beta, how do you know that the beta is going to be the same going forward? When they calculate the beta, they're using historical returns. That's not a prediction of the future. So that's a problem. And then, that's the main problem with it, is that the beta may be inaccurate because it's based on historical information. And then you don't know for sure about the market return as well. The same thing, based on historical information. So those are the problems with it. All right, that's the synopsis for chapter 8, and I will see you all later when I do the synopsis for chapter 9. Goodbye.